Now it's the developing story this afternoon. The South African Reserve Bank's Monetary Policy Committee has voted to hike interest rates by 50 basis points, taking the repo rate to 4.75% per annum now. 4 members of the committee preferred the announced increase, and 1 member preferred a 25 basis point rise in the repo rate. Let's look at what all of this means, especially because now a lot of people are talking about how difficult it's going to be to survive going forward, particularly those that are on credit. Sifiso Skenjana, an economist, joins us now. Sifiso, first of all, it doesn't look like a lot of economists were surprised by this decision because they anticipated it. Were you one of them?
No, we certainly, I think, have anticipated it, particularly because the Reserve Bank has tended to be a little bit ahead of the curve in terms of their interest rate hiking cycle. I certainly don't think that it's conducive necessarily, because we often talk about, when you listen to the Reserve Bank governor, he talks about price stability as a critical component of their mandate, and particularly then in context of sustainable economic growth. And in this context, we often use monetary policy to cool demand-led pressures in the economy that drive prices up. Unfortunately, things that are driving prices up in our economy are not demand-led. They're cost-push. It's oil prices. It's all the other things that are not because of core inflation, the way we look at it, and that's below 4% at this point in time. And so what it means is that you're using a cooling mechanism on an already cool economy, and all it does is that it strangles the economy. And I think at this point in time, we've got a lot of pressure. Consumers are under a lot of pressure. Wage earnings, if you even look at bank serve numbers, have also come under pressure in the last month. And so certainly means that households are under pressure. Debt servicing is going to be coming under pressure as well. And I don't think this is the right move from the Reserve Bank.
And talking about debt servicing, Sifiso, because some of the viewers tonight are also even talking about some of the loans now. The repayments are going to sting in their pockets. And think about homeowners tonight who are also going to be battling this.
I mean, I remember when the interest rates were on the downside, right? And we were saying to homeowners is that don't get too excited about the slide in terms of interest rate, because ultimately is that as soon as you're buying a home loan on a variable interest rate, it means that as soon as it goes back up, you're going to take the pinch as well. But when you then look at it as well in context of it, it's not just the homeowners. Businesses take loans, and so they push those costs up to consumers as well when their costs of financing go up as well. And so it comes in, I guess, in a number of factors, in the way that when you see an interest rate increase of this magnitude, certainly I think does become quite chronic in the way in which it impacts the consumer. And I think banks as well, because then, of course, their default ratios are going to go up because some people are not going to be able to pay their debts. And we're already seeing unemployment at the levels and already we're seeing also the shift is that a lot of people have moved out of full-time employment into temporary employment. And those are also people now who need to be able to service their debt in this kind of environment. So I think it's certainly, following also what Minister Kotungwana recently spoke about around that South Africa is in for a tough season, especially in the medium term.
And I'm keen to hear from you, because others have said in the lead up to this particular decision that while it's going to sting, and I'd like us to stay just a little bit more on the homeowners front, they were saying that we are in a better position than we were in 2008 when we saw the property market collapsing. Do you agree with those that say that we are in a better position now?
It depends what you're looking at. I think the 2008 financial crisis was predicated primarily because of a housing bubble. And so that resulted, of course, in a lot of pressure in this particular asset, which is a property asset, coming under an increasing amount of pressure. And of course, the loan LTVs, loan to value ratios that were associated with that. Pre-2008, banks would even help you pay for your lawyers' fees, etc. And so you'd have loan to value ratios in excess of 100%. And so these were all the things that were coming into being and saying, actually, is this an asset that is no longer going to carry what we've seen, I think, sentimentally as the asset that always appreciates in value. And so there was almost a reality check that came into the property market at that point in time. And so the financial crisis was predicated specifically, particularly on the back of the housing bubble. At this point in time, what we're seeing, of course, is that it's something a little bit different. It doesn't look like the things that are driving this is property prices that they inflated, etc. It's actually demand pressures, and so we're not getting sufficient demand in the economy, but we're getting a heating coming on pressures, that financial pressures that we're getting from what's happening in terms of supply chain disruptions, etc. And I mean, I think these are lessons we should have learned when the COVID hit. At the COVID time, we had seen that even with ventilators, 60% of the demand was controlled by three economies. And so it's about diversifying the global economy to be able to ensure that you are able to absorb some of these supply chain disruptions. We aren't playing well in that particular space, and that means that it translates into what we're seeing now. But the 2008 issue was mostly a housing-led issue. At this point in time, it's an economic growth, it's a demand-led issue, and we're not seeing demand coming through because of a lot of the pressures that are happening with everything that's going on in the world.